With the stock market off to a strong start and unemployment finally starting to recede, there's a sense of optimism in the air. But having been through a painful recession, no one wants to get too complacent, even in the midst of a steady recovery. As our nation continues to reboot and reset, many people are wondering what lies ahead. So here to discuss the new normal and tell us 5 financial trends to watch out for in this economic climate is the founder of the Women's Financial Literacy Initiative and personal finance author, Manisha Thakor. Hi, Manisha. Great to see you again.
Great to see you, Tanya.
So, Manisha, let's start off with savings. What kind of trends are you seeing now that have become the new normal?
So I like to say we are saving ourselves from ourselves in America. Many people have noticed that this national savings rate has creeped up. It's nearly 6%. And one of the side effects of that academics are starting to notice is that people are finding increased levels of happiness going along with those savings rates. And the reason is, instead of buying things, many of us are engaging in experiences. And experiences are something that we can relive over and over in our heads. And so I like to highlight this positive aspect to savings because there's so many baby boomers who are so woefully undersaved for retirement that trend is going to have to continue. And I want to emphasize that there is actually a positive psychological benefit that can come from this trend of saving ourselves from ourselves.
So saving equals contentment. I like that. Now, Manisha, do you agree that, because you just said that there are a lot of baby boomers who haven't gotten into the habit of saving yet, and it's a little late at this point, but do you agree that many young people now have a hard time saving up for the future because it seems so far away?
I do. I mean, I think that has been an issue that is, age old. I mean, when you're in your 20s and your 30s and life hasn't yet spit in your eye, it's really hard to imagine those scenarios for which you need to deprive yourself today to prepare for tomorrow. But what's happened is so many young people are now seeing their parents struggle that is creating a heightened sense of urgency that I have not seen in the last 10 or 20 years. So that's another upside.
Absolutely. All right. Now, how about when it comes to investing? What should we be watching out for here? What is the new normal in the investment world?
So, Tanya, I'm seeing 2 weird trends here. One I call deer in the headlights, and the other I call swinging for the fences. So typically what you see are young people being very aggressive with their portfolios and older people potentially being a little bit too conservative. But right now I'm seeing the reverse. So I'm seeing folks in their 20s and their 30s looking at the stock market and saying, why should I do this? I mean, look what it did for my parents. Nothing. Up until the last 18 months, you had a whole generation of folks that didn't see any upside to investing. So a lot of young people are underinvested in equities, which I worry about. And on the flip side, a lot of people in their 50s are saying, oh my gosh, I mean, I have very little time. I've got to swing for the big one. And so they're taking on excess levels of risk. So that's one area investing that I am worried about.
Very, very interesting. What is your advice there? We should just be taking the middle of the road?
Absolutely. I mean, it's the tried and true. Like your mom said, when you're in your 20s and 30s, you want to live beneath your means and you want to maximize your equity exposure. As you get older, you want to continue to live within your means, but you need your investments to grow gradually more conservative. And so I'd rather see people spend less and work a little bit longer than swing for the fences in their 50s and 60s.
Absolutely. Now, we also all know that company 401ks are a great way to start our investments off. But beyond that, what else should we be doing with our money?
Well, so there are a number of different things that you can do with your money. But I think one of the key things is paying off debt. So if you've got high interest credit card debt or you're heading into retirement with a mortgage, those are guaranteed returns. And there are very few places in the market you can get a guaranteed return. So I like to see people thinking about paying down debt as a solid investment in their future.
Absolutely. Now, what about the income disparity between men and women in the workplace that we've seen for so long? Are you continuing to see this, or is that gap closing?
Tanya, it is not closing yet. But again, this is one of those silver lining issues. So right now, women continue to make 77 cents on the dollar. It's like we're numb to that statistic. We've heard it so often. But it takes on a new meaning because more of us women are now the primary and co-breadwinners in our households. So what was once a female issue, a women's issue, is now becoming a family issue. So I'm cautiously optimistic that the issue of pay inequality is going to become one that we'll discuss on a national basis because it affects everybody.
Absolutely. It affects, like you said, families. So when it comes to jobs now, what has changed? I mean, the numbers go up, they come down, but what is the new normal in the employment scenario?
You know, the new normal, I think, Tanya, is the lack of what I call corporate big brother, is this benevolent financial safety net. You know, I'm 40 years old, and I remember growing up and going to the doctor, and you just never worried about visits to the doctor. Healthcare was a non-entity. Retirement, didn't need to worry about it. Your parents were going to have a wonderful pension plan. There were this smorgasbord of benefits that employers provided. Today, I think many of us are finding out that, honestly, we're all entrepreneurs now, whether we work for corporations or not. It's a very tenuous situation, and so we have to self-educate about personal finance. Our corporate employers are not going to be providing as much of a safety net as they did in decades past.
So we're much more on our own than previous generations.
We are. It's financial, rugged individualism.
Yeah, absolutely. All right. Now, what is your view on borrowing and being in debt in terms of the notion of good debt and bad debt?
This is another one that I think has just been turned upside down on its head. I like to say debt is a four-letter word, and it really is. And I think we'd become enamored with it in the 80s and the 90s, and the thought was, oh my gosh, debt is great because I can earn twice as much as I'm paying in interest in the stock market. But people didn't realize that when you're taking on debt to buy something, you don't own that underlying thing that you just bought. The bank does, or the financial institution you borrowed from. And a key area, a big bubble, I think, going forward is going to be educational debt. Because for a long time we said that's good debt, you can never take out too much of it. And now, as we're seeing with students struggling in a weak job market with huge student loan burdens, that, yeah, you can take on too much debt.
So true, isn't it? We see so many young people struggling with that student debt here on this show. All right, Manisha, thank you so very much.